A very good afternoon, all of you. So today we gonna start an interesting chapter for your intermediate group 2 CFM subject. The area is called investment decision. The area is called what? Investment decision. Investment decision we also call capital budgeting. See, we know the main important functions of financial management are procurement of fund and utilization of fund. Procurement of fund and utilization of fund. So fund can be utilized for two reasons: long-term purpose or short-term purpose. Capital budgeting are called long-term investment. So in investment decision we are analyzing which project has to invest. If we invest we will get more return. All these analyses are discussed under investment decision. There are different techniques are available for investment decision. Each technique has its own advantage and disadvantage. Most of the technique use cash flow as a tool for deciding the project. So we will discuss one by one technique. Are you ready? We will discuss one by one technique. Are you ready? Great. So first we gonna discuss a technique called payback period. First we gonna discuss a technique called payback period. So first we want to know what is meant by investment decision. Investment decision will guide you which project to be selected, which project is to be selected. So the first method we gonna discuss is what? Payback period. Let's say project A. Year 0, that is beginning now. Year 0 means beginning now. We want to make a cash flow of, that is your cash outflow. It can be outflow or inflow. Let's say outflow of 10 lakh rupees. Year 1 we will get 4 lakh. Year 2 we will get 4 lakh again. Year 3 we will get 2 lakh. Year 4 we will get 3 lakh. So we want to identify payback period. What is payback period? Payback period will tell you the period in which we are able to recover our initial investment. Payback period will tell you the period in which we are able to recover our initial investment. How to find out payback period? Very simple technique. First thing, cash flow we have to make into cumulative. Cash flow we have to make into cumulative. So we have 4 lakh first year, that is cash inflow. Second year 4 plus 4 will become 8 lakh. Again 2 lakh. It will become 10 lakh. Our investment money is what? 10 lakh. We got the 10 lakh when year 3. So we call payback period is at the end of year 3. Now let's say another project called project B. Year 0, the same cash flow of 10 lakh outflow. First year 6 lakh, second year 4 lakh, 3 year 2 lakh. How to find out payback period? For finding payback period, we have to convert cash flow into cumulative cash flow. We have to convert cash flow into cumulative cash flow. So 6 lakh. Some small technical adjustment. Okay. So year 0 we have 10 lakh. Year 1 we will have 6 lakh. Year 2 4 lakh. Year 3, let's say 3 lakh. So for finding payback period, what we have to do? We have to make into cumulative cash flow. First year 6 lakh, second year 10 lakh. Our investment money is 10 lakh. We are getting at the end of second year. At the end of second year. Now you tell me, you have A, you have B, which is best? The payback period tells that lesser the payback, better the option. Lesser the payback, better the option. So if you look in this data, it is very clear. B is the best one. Correct or not? Now let us change here it into 4 lakh. If you make here into 4 lakh, 10 will become what? 12 lakh. Now what is the payback period? Now the payback period is not second year, not third year, between second and third year. Yes or no? So how to find out? It is after second year. We want to get 10 lakh. Up to second year we got 8 lakh. So numerator we have to give what is the additional money to reach our investment amount. We have reached 8 lakh, outflow is 10 lakh, so additional 2 lakh required. Denominator, what is the amount received during the current year? Current year we got 4 lakh. So 2 plus 0.5, we can say 2.5 years. We can say what? 2.5 years. We can convert this into month also, but month always will not give you correct answer. You have to multiply with 12. So 2 years and 6 months. How interesting. Now let's say if we make here it into 12 lakh. If you make here it into 12 lakh, what will be the answer? Here 6 plus 12, we will get 18 lakh. So how to find out? Can you help me? It is between 1 and second year. So 1 plus. Numerator, what is the money? 10 lakh we have to reach. Already we have reached only 6 lakh. So the amount to be recovered is 4 lakh. What is the amount we got? 12 lakh. So we can say 1.333 years. Yes or no? So this is how we have to approve. There is 4 by 12. 1.33 years. Yes or no? So this is how we have to find out the payback period. What is the payback period decision criteria? Decision criteria under payback is lesser the payback, better the option. Lesser the payback, better the option. Are you clear? Great. One more shortcut I will tell you. See, year 0, cash flow is 10 lakh. First year 2 lakh. Second year also 2 lakh. Third year also 2 lakh. Fourth year also 2 lakh. See, every year 2 lakh. See, if every year 2 lakh, we call constant cash flow. We call constant cash flow. If the cash flows are constant, there is a shortcut equation for payback. When this will come, cash flows are same. The equation is initial investment divided by annual constant cash flow. Our initial investment is 10 lakh. Every year we are getting 2 lakh. The answer will be what? 5 years. You can counter check whether the shortcut equation correct or not. We have to make cumulative 2, 4 lakh, 6 lakh, 8 lakh, 10 lakh. See, we are getting the same 5 years. So this can be done. So every equation you can write separately in your notebook. Every equation you can write separately in your notebook. So every year same cash flow. Every year same cash flow. What can we do? We can go with a shortcut. See, this cash flow approach have some limitations. Cash flow approach, that is your payback method, having some limitations. One of the limitation is what? Payback period have mainly two limitations. I will tell you the example. This is project A. 2 lakh, 5 lakh, 10 lakh. Payback period is third year. Now you tell me which is the best one. See, A at the end of third year. B, third year we are not getting. B is coming into fourth year. Exactly if you want the answer, 3 plus 10 lakh minus 9 lakh 80 divided by 2 lakh 20. So 3.20,000 divided by 1 lakh 20. 1.167, 2.167 years. B is 3.167, whereas A is 3 years. We know under payback, lesser the payback, better the option. So which is only good? A only. But the limitation is what? See, B project, first year itself you are getting 9 lakh, this is a big amount. If you invest this somewhere, this 9 lakh, you may get another 5 lakh again. That means time value doesn't consider. Time value. Now let's say 5th year we are getting 2 lakh. 5th year we are getting 100 lakh. Still under payback period, A only best because they consider only cash flow up to payback. See, they don't look into 5th year cash flow. They will check when we are recovering our initial investment. What you getting the cash flow after the payback, this payback period is not considering. That means payback period doesn't consider cash flow after the payback. So the main two limitations are what? One is time value is not considering. Another one is what? Cash flow after the payback period is not considering. So the time value factor is overcome by another method. So we gonna discuss the second method. What is that method? Is that method is called discounted payback. That method is called discounted payback. See, what is discounted payback? Let's say the example. We have 6 lakh, 3 lakh, 6 lakh. See here, we won't directly go to cumulative cash flow. We know our cost of capital. So discount rate at, let's say company's cost for the fund is 10%. Cost of capital is 10%. We will go with the discount rate. What is discount rate? The value of rupee 1 is 1. So here the value, generally discount rate will be given in the question. But I will teach you how we can get the discount rate. So discount rate is very simple. 1 divided by 1.1 first year. 1 divided by 1.1. That will be the value for first year. That is 0.909. Why 1.1? This 1.1 came because Here we have 10%. Suppose if it is 12%, it will come 1.12. If it is 13%, 1.13. If it is 5%, 1.05. If it is 20%, 1.20. Accordingly, it will change. So this is for the first year. What will be the for the second year? 1 divided by 1.1 power of, we want now for second year, so 1 more equal to 1 second. So we will discuss how to approach 1 divided by power of. In your calculator is very easy, you can just click it. See, if your calculator, if you make 1 divided by 1.1 equal to, if you press keep on equal to, you will get for each year. The exam it will be given. So power of, we want 1.1. Power of how many years? Power of, we want now for second year. So what will be the value? 0.826. So second year it will be 0.826. What will come for third year? 1 divided by power of 1.1 power of third year, which will be 0.751. So we got the answer 0.751. So we got the discount rate. Now we can find out the discounted cash flow. So we were discussing which method? Discounted payback period. What is this discounted payback period? The discounted payback period tells that if the time value of money is not considering under the normal payback, the value of money. So here we are finding out the value of money. So cost we are identifying. So what will be the answer? We have 6 lakh into 0.909. You get 5 lakh 45. 5 lakh 45 for 55. Next, 3 lakh into this amount, 2 lakh 47. Nine three four. We will go for round off. 2,47,800. Five lakh 45,400. Don't want to make as much as this. Next, 6 lakh into 0.751. 4 lakh 50,000. 600. So we go discounted cash flow. Under concept everything same, but under discounted payback, what we do is we make the cumulative the discounted cash flow, not normal cash flow. Discount the cumulative cash flow. That means 5,45,400. Now 5,45,400 plus 2,47,800. 7,93,200. 7,93,200. See, our amount of outflow is what? 10 lakh. Whether it is reaches 10 lakh? No. So we have to do one more step. Now, if you add 4 lakh 50 also, what will be the answer? 12 lakh 43. 12 lakh 43. 800. 12 lakh 43. 800. So now it crossed 10 lakh. Balance everything same. So it is 10 lakh is crossing here. 10 lakh is crossing here between second and third year. So 2 plus. We want to get 10 lakh. Here we reached only what? 7 lakh 93,200. divided by everything discounted we take, we get 4,50,600. So 2 plus. This is how we have to do. So 10 lakh minus 7,93,200 divided by 4,50,600. We will get 0.459. So 0.459. So 2.459 years. So this will be under discounted payback. This will be under discounted payback. See, the limitation of discounted payback also is what? Suppose if you are getting an amount of 8 lakh here, they won't consider 8 lakh. Fourth year, what will be the discount rate? One divided by power of 1.1 fourth year. 0.683. 8 lakh into 5,46,400. 5,46,400. See, look here. Already we have crossed our 10 lakh. We won't take the total here. We stop the calculation. That means discounted payback also still continue the second limitation. What is second limitation? Second limitation tell that it doesn't consider cash flow after the payback period. It doesn't consider the cash flow after the payback period. This limitation is overcome by one of the number one technique called NPV. NPV stands for net present value. NPV stands for net present value. What is net present value? Present value of cash inflow minus present value of cash outflow. NPV stands for present value of cash inflow minus present value of cash outflow. You can write the equation also. What is present value of cash inflow? See, this entire total of our cash inflow. Entire up to the year. So we have to consider the fourth year also. Entire period we have to find out. So what will be the amount? Here we have to take the total of all the details. That means total of all these positive number. Total of 5,45,400, 2,47,100, 4,50,000. So total of all the number. Are you ready? So we have one more number here. You can make it here. So what is the total of all the number? The total of all the number 70,90,200. 70,90,200 minus our outflow. Our outflow is 10 lakh. Discount rate is 1. The present value is what? 10 lakh. We have to make it. That is, we are getting a present value of 70 lakh 90 out of an investment of 10 lakh. We have a outflow in extra of 7,90,200. The decision criteria under NPV is what? Decision criteria under NPV is what? If NPV is positive, positive means inflow is more than outflow, accept. If NPV is negative, reject. NPV is positive, accept. NPV is negative, reject. If two project, everything same, then higher the NPV, better the option. Two project, mutually exclusive. What is the meaning of mutually exclusive? Either of the one only we can select. So higher the one will be best. Higher the one will be best. So this is what called NPV. Similar to NPV. So we have discussed now three methods so far. We have discussed payback. Then we discussed. So a lot of methods are there. Each method have its own advantage and disadvantage. Next we discussed discounted payback. Then we discuss NPV. Now one more method, profitability index, PA index or cost benefit ratio. Cost benefit ratio. What is this profitability index? See, two project A and B. Outflow one day is 10 lakh, one day is 5 lakh. If the outflows are different, best method is PA. PA is very easy. If you understand NPV, PA also clear. PA means present value of cash inflow divided by present value of cash outflow. Present value of cash inflow divided by present value of cash outflow. What is present value of cash inflow? In this example, 70 lakh 90,200 divided by 10 lakh, 1.79 times. The decision criteria under profitability index is what? Greater than 1 accept. Greater than 1 accept. Less than 1 reject. Greater than 1 accept. Less than 1 reject. So this equation also you can write. Greater than 1 accept. Less than 1 reject. If 2 or more project, then higher the index, better the option. Then higher the index, better the option. Got it? So we have discussed NPV, profitability index, discounted payback. If you look all the concept we have discussed, we were finding what? Cash flow only. Yes or no? So I told for entire decision making we use what? Cash flow. Sometime question cash flow will be missing. Sometime in the question cash flow will be missing. So we have to find out the cash flow. We have to find out the cash flow. How to find out the cash flow? Statement showing computation of cash flow we have to find out after tax only. Tax is a outflow, so we have to find out after tax. Statement showing computation of after tax cash flow. Generally, any business main cash inflow is sales. So sales less cash operating expenses. We generally call before tax cash flow. We call it as before tax cash flow. Or otherwise, if all the sales are on cash, we can call this as another one name called. We call this as another one name called EBITDA, earning before interest, tax, depreciation and amortization. Earning before interest, tax, depreciation and amortization. Now less, what we have to find out? After tax cash flow. So we have to find out the tax amount. Tax is paid on profit before tax. So we want to find out PBT. In order to find out PBT, we will less depreciation and amortization if any. Depreciation and amortization if any. This is called EBIT. See, we know we find out cost of capital here. I told discount rate we take by cost of capital. Cost of capital is weighted average cost of capital, which consists of KE, KD, KP, everything. That means interest also considered here. So one of the principle of capital budgeting is that interest will not be considered. What is that? Interest will not be considered. Though interest is an outflow, we won't consider interest as outflow. So this is also called a PBT. Exam purpose, there won't be no confusion. Nowhere they will give interest. So EBIT is also called PBT under this concept. So whether EBIT or PBT, both we will call point number 3. From the PBT, we have to pay less the tax. If you less the tax, you will get Profit after tax. You will get what? Profit after tax. We know depreciation we just reduce. Depreciation is not an outflow. There is no cash outflow for depreciation. We just reduced to find out our real tax amount. So we have to add back all non-cash expenses. So add depreciation and amortization, anything. If you add, that is what is called after tax cash flow. This is one of the main interesting concept of capital budgeting technique. That is very advanced question. You have to check whether the question is given after tax cash flow or not. Because if the question after tax cash flow is not there, first we have to find out the after tax cash flow. If after tax cash flow is there, there is no problem. We can directly go to the each method we were discussing. We were discuss lot of method. We can directly go for each method. So this is very important for your exam perspective. Please copy in your notebook. Statement showing computation of after tax cash flow. You can post the video. Please copy in your notebook. Please copy in your notebook. One more thing I would like to tell you. See, suppose you are finding out the NPV. There is a one concept I will tell you. Are you ready for it? Great. One simple easy concept. First year the amount 5 lakh, second year 5 lakh, third year also 5 lakh. See how we will find out NPV. We know we will have one column for discounted cash flow. What is the equation for NPV? Present value of cash inflow minus present value of cash outflow. So what we will do? This will be 10 lakh. We will find for each. Yes or no? This is the inflow. Present value we have to take. This is how we have to find out the present value. So how we will make? We will make 5 lakh into 0.909. 4 lakh 54 500. 4 lakh 54 500. Next 5 lakh into 0.826. 4 lakh 13,000. Next 5 lakh into 0.751. 3 lakh 75 500. So how we will find out NPV? All the positive we will add. All the positive will add. What is the all positive total? 12 lakh 43,000. 12 lakh 43,000. That is inflow. Minus outflow, which is 10 lakh. You will get 2 lakh 43,000. That your NPV will be 2 lakh 43. See, this question having one speciality. What is speciality of this question? Every year, same cash inflow. See, 5 lakh, 5 lakh, 5 lakh. Every year, same cash flow. See, every year, same cash flow. We can do one shortcut. No need to make this big table. We can do in a shortcut method. How? This is a discount rate. 0.909, 0.826, 0.751. We can take the sum total of that three. That is, we call it as annuity factor. That is what we call it as annuity factor. Generally, that will be given in the question. What is the total of annuity factor? It's very easy. 0.909. 0.909. In your calculator, if you have GT option, very easy. In your calculator, if you have GT option, very easy. 1 divided by 1.1 equal to 3 times. Go and click the GT option, you will get the answer. So 0.909, 0.909 plus 0.826, 0.751, you will get 2.486. See, look here, NPV equal to 5 lakh into 2.486. See, we should able to know the shortcut, and only we can save the time very well. Shortcut method. You look here, 5 lakh into 2.486, the same 12 lakh 43 you get. Your answer also the same. Only this much small calculation. So this can be done when you have very year same cash flow. If you have very year same cash flow, we can do. So the main thing we have discussed that if the question, if cash flow is not given, how to find out the cash flow. If the question cash flow is not given, how to find out the cash flow, we have made it. So please copy it. So we have discussed now what was the method: payback, discounted payback, NPV, and also one more method. What is that method? Profitability index. So once you complete the note, you can open your study material. We have some theory part is there. This theory also you can read now. We have some introduction theories there. So you can read this introduction theory. And what role we have discussed up to now. We have discussed now 4 method. So up to 4 method, please read. Okay. So complete the note, read the theory. We will go for problem then. We will go for problem then. While you do the problem, you will understand the concept very well. While you do the problem, you will understand the concept very well. Are you ready? Super. So please start reading theory part. Yes. So we will go with the problems. We'll start with question number 47. We'll start with question number 47. Compute the NPV for a project with a net investment of 1 lakh following cash flow if the cost of capital is 10%. Net cash flow for year 1 is 55, year 2 is 80, year 3 is 15,000. See, I told already discount rate will be given in the question. They have given discount rate. But for our class purpose, I have not given all the question discount rate. Some of them we have to find out. Are you ready? So we will go with 47. So calculation of NPV. Calculation of NPV. Year 0. Year 0, what is the cash flow? 1, 2, 3. Year 0, the cash flow is 1 lakh. First year, what will come? 55. Second year, 80,000. The last year, 15,000. Discount rate at 10%. First year 0.909, 0.826, 0.751. So discounted cash flow. 1 lakh outflow, 55,000 into 0.909. $55,000 0.909. 49,995. $80,000 into 0.826. 66,080. 50,000 into 0.751. 11,265. So what we have to do? We have to add all the details. So NPV equal to present value of cash inflow. Present value of cash inflow means total of all the positive, which is lakh and 27 340 minus the outflow 1 lakh, we will have 27,340. This we can do here also shortcut. Simply we can write NPV, add all the positive minus 1 lakh. We will get here itself 27,340. So this is how we have to approach that. Question number 50. Suppose we have 3 projects involving discounted cash outflow of 5 lakh 50, 75,000, 1 lakh 200. Suppose further that discounted cash inflow. So cash inflow, cash outflow both are given. Calculate desirability factor. Desirability factor is another name for what? Profitability index. So how to find out profitability index? Profitability index equal to present value of cash inflow divided by present value of cash outflow. So inflow is first one 6 lakh 50 divided by 5 lakh 50. Second one 95,000 divided by 75,000. Third 1 lakh 30,000 divided by 1 lakh 20,000. So 6 lakh 50 divided by 5 lakh 50, 1.18 times 1.18 times. Next 95,000 divided by 75,000, 1.26 67 times. Next 1 lakh 30,000, 20,000, 1.0111 times. See, they are not telling to the ranking, but we can do ranking for better understanding. Higher the index, better the option. So this will be rank 1, this will be rank 2, this will be rank 3. All are above 1, very good option. So going further, now we will go for question number 53. Now we will go for question number 53. Are you ready? A company has to make a choice between 2 projects A and B. The initial cash outflow of 2 projects are lakh and 35 and make it lakh and 40, not 2 lakh 40, lakh and 40. There will be no scrap value. The opportunity cost is 16%. Annual income, that is your income, nothing otherwise tells that is your cash flow only. No tax and no other details of cash flow only. Project A, project B. Discount rate also given in the question. They are asking us to find out discounted payback, profitability index, net present value. Are you ready? So first we will do for project A. So question number 53. First we will do for project A. So how it will come for project A? Year 0 cash flow. What is the outflow we have to make? 1,35,000 outflow. First year nothing is there. Second year 30,000. Third year 1,32,000. Fourth year 34,000. Fifth year also 34,000. So each year we are getting what? 34,000. So discount rate at 16%. We will first find out what we call discounted payback. So we will have 1.743, 0.641, 0.552, 0.476. Now discounted cash flow. Here 1,35,000. 30,000 into 0.743. 30,000 into 0.743. 22,290. 1,32,000 into 1,32,000 into 0.641. 84,612. 84,612. 34,000 into 0.552. 18,768. 18,768. Next is 34,000 into 0.476. 16,184. We will get 16,184. Now they want us to find out what discounted payback. So we know for finding discounted payback, what we have to do? We have to convert into cumulative. So discounted cumulative cash flow 22,290. 22,290 plus 84,612. So what will be the cumulative? 1,06,000. 1,06,902. One more item. 1,25,000. So still we are not covering. 1,25,670. So one more we have to go. 1,41,854. So we have to do what? It is coming 4 and plus 5 year. So 4 plus. We have to cover discounted payback only. So 1,35,000 minus. What we have to cover? 1,35,000 minus 1,25,670 divided by, so balance money. Current period we got what? 16,184. So 4 plus 1,35,000 minus 1,25,670. 1,25,670. 9,330. 9,330 divided by 16,184. 16,184. 0.5765. So 4.5765 years, or we can round off 0.57, 0.58 years, payback period in years. So we got the discounted payback. Now we can find out NPV also. What is the equation for NPV? Present value of cash inflow. Present value of cash inflow minus present value of cash outflow. So how to find out? Inflow is what? Total of all the positive. Total of all the positive is 1,41,854 minus 1,35,000. So the difference will be what? 1,41,854 minus 1,35,000, 6854. 6854. That is what? NPV. We can also find out profitability index. They were asking now profitability index. What is the equation for profitability index? Present value of cash inflow divided by present value of cash outflow. What is the inflow? 1,41,854 divided by 1,35,000. What we will get? 1,41,854 divided by 1,35,000. 1.05 times. See how interesting. So we have completed full calculation for project A. We have done full calculation for project A. The same way we have to do for what? Project B also. The same way we have to do for what? Project B also. So what you can do now? You can post the video. You can copy all the answer. You can try yourself for project B. You can try yourself for project B. Anyway, for your better understanding, I will do project B also for you. I will do project B also for you. So what is the project B? Here it is. Yes or no? So we made 1,40,000 as the outflow. So we will start with project B. Year 0 to year 5. First year, second year, third year, fourth year, fifth year. Cash flow. What is a cash outflow? We just rectified the number as 1,40,000 outflow. So first year 60,000, second year 34, next 36. 1,02,000, 30,000. So discounted payback first we will do. For that discount rate we require. What is the discount rate? Discount rate at the rate of 16%. So first year we have already the discount rate with us. We can copy this also. Or else we will make it 0.862, 0.743, 0.641, 0.552, 0.476. Discounted cash flow. 1,40,000 outflow. We have 1,40,000 outflow. So we have to do for each case. Are you ready? So how to start? 60,000 into 0.862. 0.862. 51,720. 51,720. 34,000 into 0.743. 25,262. 25,262. 36,000 into 0.641. 23,076. 1,02,000 into 0.552. 56,304. See, if it is, you believe that if it is completed, not even before going last year, you can find out the cumulative. Cumulative will be what? 51,720 plus 51,720 plus 76 982 plus 1,58,000. 1,58,000 plus one more year. That is what I told you. Don't want to go up to last year. 1,56,000. 1,56,000. 362. 1,56,000. 362. That is the limitation of discounted payback or payback. After the payback, we won't consider. So we can find it coming between third and fourth year because our investment is lakh and 40. So we can make discounted payback as 3 plus. Discounted payback as 3 plus. We have to cover what? 1,40,000. So far we have covered what? 1,58,000. Current year we have 56,304. So what will be the answer? 1,40,000 minus 1,40,000 minus 1,58,000. You will get 39,942. 39,942 divided by 56,304. 39,56,304. You will get 0.7094. So 0.7094 years. So your answer will be 3.7094 years. Next NPV. What is the equation of NPV? Present value of cash inflow. So we have to do for one more year. Then only the answer will be complete. So what will be that one more year? 30,000 into 0.476. 0.476. You will get 14,280. 14,280. You can add all the positive. All the positive will come. 1,70,642 minus cash outflow, which is 1,40,000. 1,70,642 divided by 1,70,642 minus 1,40,000. You will get 30,642. 30,642. Similarly, we can find out profitability index. Present value of cash inflow divided by present value of cash outflow. 1,70,642 divided by 1,40,000. What will be the answer? So instead of minus, we have to divide 1.219 percentage. 1.219 times. So we have done all the method. So once you finish it, you can make it an analysis table also. You can make it an analysis table also, though they are not asking specifically. So project A, B, you can go for decision also. First is what? Discounted payback. A, how many period? A, 4.58 years. B, 3.709. We know all the payback, lesser the payback, better the option. So under payback period, we can go with project B. Lesser the payback, better the option. Next NPV, you will have 6854. 30,642. We know NPV is what? Higher the NPV, better the option. Higher the NPV, better the option. Still it is go for P. Last but not the least, profitability index 1.05 times. Higher the index, better the option. 1.219 times. Still the B. So we can give the comment. Most of the option B is preferable. Most of the option B is preferable. How interesting. So we have completed that question. See, this is one of the previous year question. Question number 67. We have A and B. Add one more method, payback also. We will do payback also. We have discussed 4 methods, we will do for payback also. Information on 2 project is given, A and B. Rupees in 1000 they have mentioned, 50 to 82. Initial investment they have mentioned. Evaluate the project under each of the following. Discount rate is 10%. So discount rate, it is a previous year question, they given 6. But here we will find out. If it is not here, we will find out. Are you do? So we will do only for A. We will do only for A because already we have done 2 questions. Once we done for A, B you can do it as a homework. Once we do A, B you can do it as a homework. Are you ready? So we will add one more method, payback also. We will do one more method, payback also. So we will go payback. We will not go as per the order of question. We will go as per the exam purpose. We have to go as per the order of question. But here in this question, for understanding purpose, we will go payback, discounted payback, NPV, profitability index. Are you ready? I am here ready for you. So we will go for it. So we will have project A. Year 0, 1, 2, 3, 4. Rupees in 1000 common only. So 535. Everything they have made. So initial investment. So investment beginning of the year means 0 only. Beginning of the year means 0. 535. So investment is an outflow. So first year 50. 300, 360, 208. So we gonna do now first normal payback. Normal payback, we have already discussed the concept. Now first one problem will be very easy. Simply cumulative cash flow. Simply what? Cumulative cash flow. So 50, 350. So 350 plus 360. 350 plus 350 plus 360, 710. So we will come 710. We can stop because our outflow is what? 535. It is already crossing. So we will go for what? First normal payback period. Though it is not asking in the question, we are doing for our revision purpose. So what will be the answer? It is after 2 years. We want to get 535. Up to 2 years we got 350. Third year we got 360. So what will be the answer? 2.535 minus 535 minus 350. 185 divided by 360. 0.514. So you will get a 2.514 years. 2.514 years. So how interestingly we have completed for payback. Now we will go for discounted payback. Now we will go for discounted payback. For that we have to find out discount rate at 10%, because the question they tell 10%. We know 10% first year is 1. Second year already we have done 0.909, 0.826, 0.826, 0.909, 0.826, 0.751, 0.751, 0.683. So discounted cash flow. See how discounted cash flow. This is point number 1. This is point number 2. This is point number 3. This is point number 4. Point number 2 into point number 2 into point number 4. This is point number 5. Point number 2 into point number 4. So we have to find out. So here we have already we know 535 also. So are you ready? So 50 into 0.909. 45.45. 300 into 0.826. 247.8. We will make 2 decimal point everywhere. 247.80. 360 into 0.751. 270.36. See how interesting. We know discounted payback. We have to find out discounted cumulative cash flow. We have to add for each year. So 293.25. Again, if you add 563.61, 563.61. So we have reached it. So it is between 2 and third year. Here also between 2 and third year. So 2 plus. We have to cover 535. We have reached only up to 293.25. Current year we got 270.36. So what will be the answer? So 535 minus 293.25. 535 minus 293.25. 241.75. 241.75 divided by 270.36. How interesting. 0.8942. 0.8942. So the answer will be 2.8942 years. So the answer will be 2.8942 years. So we got normal payback, discounted payback. Now we have to find out the NPV. What is the equation for NPV? Present value of cash inflow minus present value of cash outflow. So what is the present value of cash inflow? We have one more here is pending. We will do that also. 208 into 208 into. Suppose if the question they are not asking NPV, we can stop the answer now itself. No need to find out the after payback. But here they are asking, so we are good. 0.683. 142.06. 142.06. So we have to add a total of all the positive. Total of all the positive is 705.67 minus 535. So 705.67 minus 535. you will get 170.67. 170.67 we will get NPV. Last but not the least, profitability index also they are asking. What is the equation for profitability index? Present value of cash inflow minus present value of cash outflow. You will have one doubt, sir. With this we can do. Yes, you can do it. You have to take proper note for everything. So 705.67 divided by 535. 1.139 times 1.319 times 1.319 times. Okay, so we have completed the problem on what? NPV. We have completed the problem on NPV profitability index. So project A is now over. Project A is now over. Now you have to do project B as yourself homework. You have to do project B as yourself homework. So project B, you want to do it as a homework. You want to also do one more question. Or is this enough for homework? Since this is the first introduction session, I don't want you to go much question and much in detail because we just started today only. So only one question you want to do. Balance we will discuss. So this is enough. So for project B, do yourself. Project B, do yourself. So let me remind you one thing, what all we have discussed. See, we have discussed all the method, payback period, discounted payback, NPV, profitability index. See, this concept, computation of after-tax cash flow. See, so far we are not tested. One of the important area in capital budgeting. Since we are starting with the basics today, it is not tested. So in the coming classes, we will test that because this concept is very important. You should recall. This concept is very important. You should recall. See, if you look into the some previous year question and all, it is test is there. Everywhere it is test is there. See, if you look this question, they were asking payback, discount payback, net present value, everything you know. But I am not giving homework. Why? Because they are not given cash flow. They are given annual income after depreciation, but before tax. Similarly, here also we find some questions. See, here they tell what? Net cash flow before tax. So like that they are giving. So how to approach for that purpose? You should be able to know this concept very well. So make it copy all the note properly. In the coming classes, we will discuss all these logic and also more other techniques of capital budgeting and more other techniques of capital budgeting like IRR method, ARR method. So keep on your study. God bless you. Thank you. All the best.